So yesterday, after the dust settled, what a crazy day it was. Stock market dropped a lot. You also had the VIX hit levels that it has not seen since like 2020. And I was looking at the VIX. Take a look at this weekly chart. If you take a look at the VIX has only made a move like the one we saw yesterday 2 other times in recent history. One was during 2020 and one was during 2008. And I thought this was kind of interesting and worth mentioning because the VIX, for newer traders who may not be familiar with the VIX, is an index that tracks volatility and expected, more likely future expected volatility in the financial markets, specifically the S&P 500. So the VIX is an interesting instrument to study because what the VIX tells us is that when you get these huge spikes, it means the market is very, very scared. And so yesterday you had a lot of fear come into this market. But what do we know about fear? Fear is typically a very good opportunity in markets if you are being responsible, trading, without margin, without taking huge gambles or risks. The VIX can be a lovely indicator of perhaps opportunities showing up in the market. So I'll show you something I thought was interesting. These 3 environments, 2008, 2020, and today, share a similar characteristic. The VIX spiked so fast during these times, then proceeded to do what? Proceeded to fall. Now, I'm not saying that the bottom of the VIX is in, or the top, of the VIX is in. We could theoretically see this thing shoot up and take out the highs. In fact, if we take a look at a weekly chart here and we zoom in a little bit what happened in 2020, you can actually see that the VIX shot up like this, and then it shot up again, and then it shot up again for a 3rd time before it finally started to truly come down. So with the VIX spiking the way it did in the last few days, you'll notice that we're doing something kind of similar. Big VIX move up, then we followed through again, then we followed through again. And the big question on everybody's mind today is, are we going to see another spike through the highs? But here's something I want to point out with this. Anytime the VIX has been doing this, historically speaking, it's not necessarily, an easy timing vehicle because, again, you may think the VIX has reached its top and then it just shoots up again and then shoots up again. But what we know is that when the VIX is getting at these levels, it usually doesn't stay there for very long. So when you get the VIX moving up, it means that a lot of fear has come into the markets. It means people are terrified. It means people don't know what's coming next and they, want to get into cash, or they want to go short, or they want to, they want to try and run and hide. But historically speaking, a VIX spiking dramatically like this is a pretty good time to take some calculated risk. And personally, that is what I am doing right now with a couple different charts. I've been mentioning that I've been trying to buy the indices, buying some areas of the market that I particularly like. And I'll say that for me, I've got a game plan that I wanted to share a little bit with you guys today on how I'll be treating this correction potentially forming in the financial markets. So I'll go through my game plan with you guys because this is not going to be if you watch my show, regularly, my streams and my videos and stuff, I'm not a day trader. I'm more of a swing trader. And so when I see these big spikes lower in the stock market's getting really emotional, I start getting excited. In fact, I would like if the market pushes lower, even though I have some long positions in the market right now. The ideal situation, if 6 months from now, the market is higher, and I'm talking specifically about like the S&P 500 guys. So if in the next couple months we see the market dip, this would be ideal for me in the longer run. Personally, I'll tell you why. The reason is because in my personal, kind of financial situation, I'm sitting on some cash, meaning I have room to continue buying the dip. And I want to point this out because some people are going to, see me if this happens. They're going to say, Nick, you have just been horrible with your timing. But stock market crashes are very hard to time a bottom. And the purpose of me sort of scaling into this idea is that I am definitely not trying to call a bottom. In fact, why would I like the market to take out this low and stop me out on this position before going higher? Well, because if it does, I have a personal rule. And this is a way that, I think everybody should have their own rules, but here's one of mine. I don't like to dollar cost average or just buy the stock market when it feels expensive. I have not been adding to my stock account. I've not been adding to my trading portfolio for some time. But I do add to my portfolio during sell-offs. I added to my portfolio and ended up being a very wise decision in late 2023. I added tremendously to my portfolio in 2022. I add to my account during down months and years. So I have a game plan mapped out personally on how I'm going to be treating the sell-off in stocks. And I've mapped it out on VOO. These white levels are areas at which point I will be adding to my trading account balance. Why would I be adding to my trading account balance? Well, first of all, I have cash sitting on the sidelines in my personal life. I don't trade, 100% of my money at any point in the market. I have cash on the sidelines. If we see the stock market roll over, then I think you start getting some really advantageous pricing on some of the companies that I really like for the longer term, as well as some good dip buying opportunities on the indices. So I am bullish overall. I think that, if 5 years from now, I'm buying this whole way down, I think I'll be really happy that I did that.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
So just wanted to give you guys my thought process. Everybody gets all fearful. They get terrified during a time like this. They see the VIX spiking up and people start making really, kind of rash decisions. But in my view, take this as a good thing. It is an opportunity. If especially you're somebody who is, looking to maybe make a, longer term buys of certain things that you like, this can be a really great opportunity to add to those companies that you like, or perhaps, maybe even you see a big dip in gold. If you're somebody who likes gold for the longer term, think about it as an opportunity. Don't think about it as a fear event, right? Don't get caught up in all the fear. You're going to have plenty of that all over the place. People are, terrified during market environments like this. I actually, as much as I am, I'm long, I have some positions I would like to go up. The ideal situation for me is actually the market to continue going down so that I can start adding and building at much better prices into companies that I like and buying indices at lower prices. So just wanted to give that message because I know a lot of people are, watching this market and they're terrified. Oh my gosh, it's going to crash, and just something to think about. Anyways, let's also take a look at gold here this morning. So gold came down, tapped into this 2360 level. I mentioned that I like this area for a possible buy. So if we see gold roll over, same thing applies. I am bullish on gold overall. And so dips into 2360 or 2300, in my view, are opportunities. So I'll be watching those closely to see if we can get a little bit more sell-off in the price of gold. Again, I want to kind of phrase it as this. I am looking forward to a bigger dip in markets. That would give you opportunities if you're, liquid enough, if you're not, over leveraging your account or being irresponsible. It gives those types of people a great opportunity to build positions and things at lower prices. What about seasonality? You're buying in summer months? Yeah, let's take a look. So seasonality, good point. Let's take a look at the month of the year trends. And August, let's take a look at, by the way, gold, historically a pretty good month for August, August is historically, in the last 10 years, a pretty good month for gold. Let's take a look at the S&P 500. So take a look at the S&P 500. August is expected to be a 1% gain. So obviously, first couple days of August have been really rough, but on a longer term, 10-year historical average, the S&P 500 has averaged about a 1% gain in the month of August. September is the worst historical month of the year going back for many years. Obviously, we've got the 10-year calculation here, but I believe going back as far as 40 years, the S&P 500 has averaged a flat or negative gain. Now, of course, over the very long term, stocks tend to go up, but in the short run, they can be very, very volatile, as we've seen, again, with the NASDAQ dropping like 6% the other day. I mean, crazy stuff. So volatility, that's why they call it shorting, right? If you're short the market, a lot of people would consider it like a short-term bet against the market. And obviously, if you've been short, then you've been making a lot of money during this past couple of weeks. But anyways, so, in terms of seasonality, the old adage, sell in May and go away, has actually been a really bad strategy for the last 10 years. If you sold in May and walked away from stocks in the last 10 years, you missed out on some of the best gains of the year. Take a look. May positive, June positive, July up 2% on average for the S&P, up 1% in August. I mean, that's a historically meaningful period of strength for the stock markets during the summer months. So, yeah. Take a look at the top setups page for the day. Let's take a look of take out our neutral readings for a moment. We've got gold still up here. You got the S&P and Dow giving slight bullish readings. Gold, I am looking for opportunities if we do see a bigger dip. The burden from here with a big sell-off like this is sellers have to continue this trajectory. They have to continue this speedy sell. Otherwise we've got issues for the sellers. Here's what I'm trying to get at. Okay, if you're somebody who's looking at this chart and you're a bear, right? If this thing just goes sideways, because suddenly dip buyers are going to say, well, why aren't the sellers continuing the push? And what does the market typically do? Typically drifts up. Not always, but it typically drifts up. So if you're a bear, you're probably looking for follow through quick. I mean, if I'm bearish right now, and I'm not, but if I was bearish, what I'm looking for is just give me that flush through the lows pretty quick. Otherwise, I need to take profits or get out of the trades, because follow through is really important for bearishness, because stock market typically moves like this. Very slow upward gains. I mean, we're seeing it directly on our charts right now. Slow, gradual uptrends, rapid downtrends. If you catch one of these moves, you can make a lot of money, right? If you're short during a time like this, absolutely you can make a lot of money. But to me, the burden right now is on the bears to prove it that we shouldn't just bounce from here. Why shouldn't the market, with such good companies, such dominant, the ginormous companies that lead this stock market, why shouldn't people go in and buy the dip if Japan is stabilizing, right? Remember, I think Japan was the trigger to this global sell-off. But Japan bottomed out, rallied back overnight, guys, 13% from the lows, 14% from the lows. I'm not saying this is the bottom for sure, but you do have to consider that sellers need to follow through in the coming days, or we may have found a bottom. So the Russell 2000 index is an interesting one. It's smaller and mid-sized companies in the United States. These companies have been really not doing very well in the last few years. Take a look at the Russell 2000. If you had bought and held this thing since 2021, you're about flat on your entire investment during a 1,300-day period. This is personally why I'm not a big advocate for just buy and hold. I know that for people who are not interested in putting in the work of trading, buy and hold is great. But for traders, I mean, to make 0% in 1,300 days is, not fun. That being said, I do think that this thing, if we look forward, has room to continue to go higher. The reason for that is because if you're taking a look at the rate cut situation, let's take a look at some data for a second. If we take a look at where interest rates are expected to go, well, inflation has been coming down, came down a lot, went sideways, and is starting to come down. I expect that with the recent slowdown in the economy, we're probably going to see inflation come down further. The question, though, about whether you want to buy the Russell or not is all about this. Is the economy okay? Because if the economy is not okay, if you've got serious problems in the economy, then my trade on the Russell might be really early and might be a bad one. But if the economy is not falling apart, and there's some things I would point to that suggest that it's not falling apart just yet, like for example, services PMI yesterday, I think we didn't get our latest. We got to check this. This services PMI is missing from yesterday. Anyways, services PMI came in and it beat estimates yesterday, just slightly. And that might have saved the day for the stock market because people are terrified about the recession possibilities. Is the world going to fall apart? The economy? Well, GDP beat estimations by a wide margin, 2.8%. And the Atlanta GDP now, the Atlanta Fed's GDP now, which has been a pretty dang accurate indicator of GDP. They're like the best in the business, I would say, for trying to predict growth in the US economy. Still is projecting 2.5% growth. That's nothing to scoff at for US economic growth. Not to mention, if you're going to see a recession, do you guys remember that the technical definition for a recession is 2 consecutive negative GDP growths? So if you think that the market is going into a major recession, it could, but again, the bears have got to prove that because the US economic growth has been very strong. So again, if you are somebody who is just uber bearish on the market, we've got to see GDP growth go negative. You've got to see, labor data fall apart. You've got to see inflation, go down dramatically because of lack of demand, lack of growth. And again, I'm not saying it can't happen, but I'm looking at the data in front of me and I'm saying, I don't quite see it. Now, if you want to get bearish, you could point to retail sales and you could say, well, look, the consumer is not spending more. They're hurting. Inflation has really robbed them of their savings. And that is kind of true. But net household incomes, which we don't have in the Edge Finder, are up. We see people who, have benefited from the rally in stocks in the last few years. House values are up a lot, so people are feeling a little bit wealthier. What's kind of weird is that here's another company. I get that people are concerned about a recession, but here's AXP. This is American Express. American Express doesn't seem like it's going into recession. Their earnings have been phenomenal. They're making money. They did miss on their revenue the last time around, but they're not falling apart. Now, if you want to get bearish, here's UPS. UPS, terrible earnings. That's the economy. That's concerning. Don't get me wrong. There are signs of a slowing economy. But my point is this, and why I'm still bullish is I say, well, yes, there are signs of things cooling off. That's what we needed to see for rate cuts. And with the rate cuts that are expected to show up in September, here's what I think would be best case scenario. If you want the market to go up, if you're bullish, right? Chris, will be on 10 minutes? Okay, cool. Oh, sweet. So check this out. If you want the market to go up, here's one thing we don't want to see. An emergency cut. Please don't do that. So yesterday, we saw a lot of people get all like, oh my gosh, the Fed's going to cut rates in an emergency meeting or announce that. That, to me, may sound like a decent idea, but can you imagine the absolute fear of Jerome Powell on that fabled Wednesday where he came up and said, we think we've done it. We think we've got inflation cooling, labor data cooling. We think we're going to be able to cut rates and get away with this. Basically, is what he was saying. I'm paraphrasing heavily, but he says that. Can you imagine if a couple days later he comes out and says, actually, we're going to emergency rate cut? Market would hate that. So let's not do that. And I don't think the Fed's going to do that. It was all over my feed, people saying the Fed's going to need to emergency rate cut to stop this thing from selling off. I don't think so. And I think that would be bad because if you saw a Fed rate cut, it would look irresponsible. It would look like the Fed is admitting that they were wrong, and that would not look good. Now, is the Fed wrong? Is the Fed too late? Maybe. But again, we just went through a list of economic indicators that are not showing, the worst thing ever. Company earnings hanging in there for the most part. Retail sales not particularly great, but services PMI beat yesterday. GDP growth beat. We still added jobs, right? I saw somebody talking about, here's one thing I wanted to discuss. And I don't know how much truth there is to this, so maybe somebody can look into this and share it with us, share it with the class. I've heard that a lot of the concerns around this last jobless claims statistic that came in were a little bit skewed by the hurricane that is happening in Atlanta's southeast, right? I'm sorry, Atlanta, America's southeast, right? Florida. The hurricane in the Gulf. Supposedly, and I don't have any facts in front of me. I've just heard people talking about this. The possibility that this could be skewed a little bit higher than what is actually, normal because of the hurricane situation. I've also heard people are coming back to work in waves, and that is causing a little bit of more joblessness or unemployment claims. And then finally, the 114,000 jobs, is that a bad number? Yeah, it's a bad number compared to recent history. But over long-term history, it's not like a devastating number. We still added. So I just don't see why I currently don't have a reason not to be looking for dip buying opportunities.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.